Hey, wild swings for these markets these days, and a lot of market watchers, including Stuart Varney, blaming computer trading. Joining us now, Teresa Goody, former SEC attorney. Let's talk about this high-frequency trading, the algorithms, because, you know, Teresa, I look at 1987. After that crash, there was a Brady report, a 304-page report to Congress, and they squarely blamed it on computer trading, portfolio insurance. And here we are, this many years later, still, by many accounts, being victimized by the computers. Can anything be done?
I think something can be done, and I think that when you have 400 to 500 point slides and 2 to 3% changes in the market in a single day, that's indicative of a market structural issue. And I think you and Stuart and Secretary Mnuchin are right on that this is high-frequency trading is a huge impact for this. And I think what we need really is we need disclosure to the SEC to see what the algorithms are. And I realize that there is some proprietary information there, but this is a disclosure regime to the SEC to protect orderly and efficient markets that protect investors. And we don't have that right now. And I think high-frequency trading is undermining that. And so being able to see what the high-frequency trading algorithms are, whether there's anything manipulative there, whether there are windfalls in these huge slides, is something that I think we need to look at. And some market structural issues need to be, rules need to be changed.
Well, here's the thing. On Wall Street, you have typically two defenders of these. Those folks who make a lot of money from them, and those who have been around long enough to say, hey, you know what? Ultimately, these kind of devices destroy themselves and their users. And so just sit back and wait for that to happen. Meanwhile, it's not doing anything for the average investor's confidence or their portfolio, is it?
No, and in fact, it's injuring investors, and whether they, explode or implode, or whether or not they destroy the market in the first, before that can happen, is another issue. I think we need to take some action now and not let them just run wild. And, there's this momentum. They exacerbate any kind of price movement. And remember, prices, that's secondary information. So there could be some minor issue or something that would have a minor impact on the stock market. And we're getting these overblown reactions because of the high frequency trading. Those algorithms kick in. They start selling off. They sell high. And then the average investor is going to act more quickly and sell to minimize losses than they are to get back in the market and then for gains.
Well, there's no doubt they manipulate the market. They're triggered and they trigger each other after a certain point. And of course, the overall psychology of the market. So you started off by talking about manipulation. They do manipulate the day-to-day movement of markets and exacerbate, particularly to the downside. So what do you think, because we only have a minute left, do you think this administration, besides complaining about it, will do anything about it?
I think so, and I hope so, and I believe that Secretary Mnuchin said he was going to have FSOC looking into it, which includes the SEC. And so we need to gather the information. We can't fix the system until we figure out what's wrong with it, and we figure out exactly what these algorithms are doing and how they are impacting the market. And then we can come up with smart regulation to try and fix the market structural issues that we're seeing, because this is an obvious market structure issue.
There's no doubt about it. Teresa Goody, thank you very much. Appreciate it.
Thank you so much.